Unlock Charlie Munger's unique approach to wealth building after 40 that you can't ignore. That's not a promise of shortcuts. It's a call to change the way you think about risk, time, and discipline when the stakes get personal. If you're over 40, listen closely. The rules you used in your 20s no longer fit. A single big loss now can erase a decade of work and leave you scrambling for returns you no longer have time to earn. This video will show you the Munger-style logic that matters most for someone with a shorter runway. Protect first, then grow. It's practical, often boring, and precisely what people who reach freedom actually do. Before we begin, a brief, clear note. This content is educational only and not financial advice. The examples I use are illustrative hypotheticals, meant to show math and behavior, not to be taken as recommendations. If you need tailored guidance, consult a licensed financial professional. Lose half at 45, and you need 100% to get back. That line is simple enough to sit in your chest. It has no charisma. It has math. If you have $200,000 and suffer a 50% loss, you're left with $100,000. To return to $200,000, you must double what remains. A 100% gain, not a 50% gain. That asymmetry is unforgiving. It's the reason Munger insisted on a margin of safety long before chasing higher returns became fashionable. When your time horizon shortens, protection becomes the lever with the most leverage. If you want a simple tool to start applying these ideas, download the free 40-plus wealth checklist linked in the description. It's a plain spreadsheet and one-page plan designed to convert these principles into actions you can do this week. Now, let's be candid about the real problem. People over 40 face three converging pressures: fewer working years left to recover from losses, rising certainty about when you'll need money, and an emotional intensity to catch up if savings lag behind expectations. That pressure breeds two dangerous reactions. One is speculation, chasing outsized returns, often in assets you don't fully understand, because you believe faster equals possible rescue. The other is paralysis. Holding excessive cash as if avoiding risk is the same as planning for your future. Both feel like control. Both are often a poor translation of it. Behavioral traps are the core enemy. People mistake regret for risk management. After a market downturn, they either leap into the latest hot asset, influenced by headlines and friends, or they hoard cash until inflation quietly eats the real value. Herd behavior, false confidence after short-term wins, and the seductive story that this time is different are all mental viruses. They don't care about age. But after 40, the margin for error is smaller, so those mental errors are costlier. Let's make that cost vivid with a simple hypothetical. Imagine a 45-year-old named Claire who has built $300,000 in retirement assets. She watches a 2-year boom in a speculative sector, sees friends posting quick wins, and reallocates 40% of her portfolio to chase higher returns. 6 months later, the sector collapses and she loses 50% of that allocation. The 40% chunk becomes 20%. Her total portfolio drops from $300,000 to $240,000, a 20% overall decline. To get back to $300,000, Claire now needs a 25% gain on the reduced total. That's not impossible, but it's harder when the time available to capture that gain is limited and when volatility has increased her psychological burden. Contrast that with a 25-year-old who suffers the same loss. They can accept volatility, dollar cost average through it and ride compounding for decades. That option evaporates as the calendar moves forward. Charlie Munger's contribution to this conversation isn't flashy stock picks or bold predictions. It's a temperament and an operating principle. Favor margin of safety, understand what you own, and avoid the seductions of activity that masquerade as competence. Munger praised long-term thinking and an unemotional, rational approach to risk. He respected math over narratives. For someone over 40, that counsel translates into concrete behaviors. Increase the margin that protects you from severe, permanent loss. Raise the things you can control. Savings rate, clarity of understanding, and allocation discipline. And shrink the things you cannot. What is margin of safety in personal finance terms? Think of it like insurance that you buy with discipline rather than premiums you hope never to pay. It's having a buffer between what you own and what you can't afford to lose. It shows up as an emergency fund that's aligned with your true spending needs, as conservative assumptions about returns when you plan, and as portfolio choices that reduce the chance of a catastrophic drawdown near your spending horizon. Margin of safety is not fear. It's rational humility applied to numbers and human unpredictability. To translate that into action, it helps to reframe your measures of success. Most financial advice for younger people centers on maximizing long-run expected return. For people approaching and in midlife, the central metric should shift toward maximizing the probability that you preserve enough capital to meet near-term needs and maintain optionality. That doesn't mean being extremely conservative in all things. It means prioritizing downside control and improving the things you can directly influence. Let's examine the behavior that separates those who make it from those who do not. There are roughly 5 recurring rules of thumb that come out of a Munger-style approach when applied to someone over 40. The first is protect before you grow. The second is increase your savings rate rather than chase higher return assumptions. The third is invest inside your circle of competence. The fourth is consistency over intensity. The fifth is consciously reduce risk as your spending horizon approaches. All 5 sound simple. Each requires discipline, a willingness to be a little dull, and a humility to reject glamour. Protect before you grow is an ethic, not a tactic. It means asking the question, what loss would be catastrophic for my plan? Then you structure your portfolio and your liquidity so that a plausible, worst-case market event will not force decisions that compound losses. Panic selling, tapping retirement accounts with penalties, or selling a home in a down market. Practical micro-actions include increasing liquid reserves to cover 2 to 5 years of essential spending if you are in a job with uncertainty, or shifting a portion of assets into less volatile instruments as you near when you'll withdraw them. Those are not sexy moves. They are stability engineering moves. They preserve your ability to be patient, and patience is the friend of compounding. Increase your savings rate is a counterintuitive but powerful lever. People over 40 often assume the only way to catch up is to seek higher investment returns. That's tempting because it promises speed. But raising your savings rate by 5 percentage points this year is a more reliable, controllable way to improve your outcomes than expecting outperformance. Savings are in your control. Market returns are not. If you can trim discretionary expenses and redirect the cash into tax-advantaged accounts or a diversified bucket that you understand, you improve your margin of safety while simultaneously compounding principal. In practical terms, small sustained increases in savings produce outsized differences over time because they both grow the numerator and reduce the need for risky upside. Invest within your circle of competence. This rule is perhaps the most Munger-like. It requires brutal honesty. It asks you to inventory what you truly understand, not what you heard on a podcast or seen trending on social media. If you cannot explain in simple terms why an investment should work or what could make it fail, then it likely lies outside your circle. The remedy is straightforward. Sell or reduce positions you don't understand and redeploy into simpler, more comprehensible assets. That doesn't mean limiting yourself to the most boring instruments forever. It means not betting your retirement on narratives you can't test and won't be able to hold through panic. Consistency over intensity is about habits. Wild, concentrated bets are intense. Systematic, repeatable contributions are consistent. A daily or monthly habit of saving and investing removes timing risk and reduces the emotional heat of decision-making. It also aligns with what behavioral finance shows about human weakness. We are worse at making one perfect decision than we are at executing many small good ones. If you automate a marginal increase in savings and set a modest rebalancing plan, you will likely do better than by trying to outguess markets. Finally, reduce risk as your horizon shortens. This is not to say becoming fearful. It is to say matching portfolio volatility with your timeline. When your withdrawal window approaches, think of sequence of returns risk. The order in which returns occur matters. A severe downturn just before retirement can devastate a plan, even if long-term averages look fine. Practical responses include gradually shifting allocation toward lower volatility assets, increasing guaranteed income components where appropriate, or shortening the duration of your fixed income investments to reduce interest rate sensitivity. Each decision is a trade-off. The key is to make the trade-offs consciously rather than reactively. All of these sound manageable on paper, but human psychology complicates implementation. We tell ourselves narratives to justify the big bet. I can recover quickly, or this is different, or this time I know when to exit. Those narratives offer comfort, but rarely survive stress testing. Munger's counsel was less about the right product and more about the right mind. He urged intellectual humility. The practical translation is a set of rituals, a written plan, a checklist before doing anything significant with capital, and a commitment to a small set of rules you do not abandon when noise rises. To see how these principles play out in real life, consider two archetypal paths. One is the disciplined path, embodied by a fictional 42-year-old named Mark. Mark did not discover magic. He increased his savings modestly over a decade, prioritized low-cost, diversified holdings he understood, and introduced a margin of safety by maintaining liquidity equal to 3 years of essential expenses. When his employer announced layoffs during a market slump, Mark did not panic sell. He adjusted his budget temporarily, took a side consulting gig for income, and let the market recovery restore lost value. His life after 15 years looks like a slower, steadier climb, with much less anxiety, and a preserved option to semi-retire earlier than expected. Contrast that with a composite improviser in their mid-50s, a person we'll call Dana. Dana spent years catching up, moved a large chunk of savings into a hot investment after a run-up, and then saw a severe correction. Without a margin of safety, Dana faced a sequence of returns problem that forced premature withdrawals and job changes at exactly the time she needed stability. The numerical difference between the two is striking not because of some miraculous return percentage, but because of the interaction of saving behavior, drawdown timing, and the psychological ability to persist. Those opposing scenes are not meant to shame. They are meant to illustrate the mechanics. The disciplined life contains smaller, more boring choices over years. The improviser's life contains bursts of excitement, followed by periods where options narrow and stress increases. For many people, the deciding factor is whether they accept the discipline to trade present comfort for future freedom. At this point, you might be thinking, that's all sensible, but how do you start? Which of these principles do you implement first? That is the precise practical question midlife investors need to answer. You can begin with 3 immediate high-impact moves that don't require market timing or arcane expertise. First, calculate your true spending horizon and essential spending needs. Second, increase your savings rate by a concrete amount you will stick to for at least a year. Third, identify one holding you don't understand and decide now whether to reduce or remove it. Imagine the mental relief of knowing, before a shock arrives, that you have a rule. No single position will ever be more than X% of your net worth. Liquidity must cover Y months of expenses, and any new investment must pass a simple 3-question test. Can I explain it in one paragraph? What would make it fail? Is it aligned with my horizon? Those rules are not glamorous, but they are stabilizing. Now, consider a more uncomfortable truth. Some of the changes required will be socially awkward. You may have to say no to friends' tips, unsubscribe from newsletters that tempt you toward activity, or decline discussions that push you toward the next speculative move. That social friction is part of the hidden cost of discipline. Most people overestimate how well they can maintain discipline in a noisy environment. One of the underestimated acts of courage at midlife is to quiet the noise. There's another dimension: tax efficiency and account structure. It's not the point of glamour in this conversation, but how you structure accounts and understand tax implications affects your margin of safety. For example, the order in which you withdraw assets in retirement can materially affect longevity of savings. That's not advice, merely a sign that planning is multidimensional. You can control account structure. You can't control the market. So prioritize what you control first. At this crossroads, an important diagnostic question to ask yourself is, what is my biggest financial behavior risk, not my biggest market risk? Often the answer is the person sitting between you and the plan. You, overconfidence, procrastination, and social pressure produce more damage than any single market downturn when you're close to needing the money. The antidote is a mix of process and small structural changes that automate the disciplined behavior. So far, we've defined the problem, explored the mental traps, laid out the 5 guiding principles, and sketched 3 immediate starting moves. We've seen how a margin of safety works in practice and why it's different when you have 1 or 2 decades to preserve and convert capital into life choices. But the next step is the most important one, and also the one that most midlife investors struggle to commit to. It's about turning principles into a specific plan that fits your career, your family obligations, and your psychological profile. That plan begins with a simple, brutally honest inventory. List your sources of income, your essential annual spending, your non-essential spending you be willing to cut for 3 years if necessary, and your existing liquid reserves. On the asset side, list every holding and next to it, write, in one sentence, why you own it and what could make it fail. Don't skip the exercise because it's uncomfortable. The act of writing it down clarifies your circle of competence and exposes positions you tolerate but don't actually understand. Once that inventory exists, create a micro-rule set you will follow when markets move. One practical micro-rule might be, if a single holding declines by more than X% and represents more than Y% of my portfolio, I will not sell automatically. Instead, I will pause, review the original rationale against new information, and consult my checklist before making a decision. Another micro-rule could be, increase savings contributions by $200 per month and automate the transfer on payday. These micro-rules address both the emotional and practical sides of decision-making. Here's the rub. Implementing these things is easier in theory than in practice because human attention is limited and habits are sticky. The behavioral finance research that Munger admired warns us that simple knowledge rarely results in durable behavior change. That's why rituals matter. Monthly automatic contributions, a quarterly portfolio review on the same day you pay bills, and a written no-go list for speculative investments are rituals that take the fight out of willpower. They are not glamorous. They are operational. We've reached the point where the abstract becomes precise. To protect and then grow, you must make decisions about allocation, liquidity, and habit. But the order matters. Margin of safety first, then savings rate, then competence, then consistency, then risk reduction as horizon shortens. That ordering protects your ability to exercise all the other choices calmly. As you consider these steps, keep 2 mental images. The first is a dam with a slow, steady overflow that feeds a river, predictable, stable, reliable. That's the disciplined plan. The second is a dam with dramatic valves that open and close unpredictably, sending sudden surges that erode the riverbanks. Exciting in the moment, destructive over time. The disciplined plan is boring, and that boredom is a virtue. The improvisational plan is thrilling and often terminates in urgent, unhappy rearrangements when life becomes less patient. Now imagine applying this logic to a real near-term decision. You have 15% of your portfolio in an asset you barely understand, and headlines suggest it could double next year. A rules-first approach produces a quick test. Does this asset fit my horizon? Can I explain why it should outperform, not just repeat a narrative? What is the downside? If the downside is more than you can tolerate without compromising essential spending, the correct answer is to reduce exposure. That decision may feel conservative, even cowardly, but it is precisely the kind of calculus that distinguishes resilient portfolios from fragile ones. There's another layer to this: social and career flexibility. Part of margin of safety is not purely financial. It's structural. It's the ability to pivot a career a bit if necessary, to take on a consulting role, or to adjust lifestyle expectations temporarily without destroying long-term plans. People who cultivate optionality, not in the sense of perpetual indecision, but in the sense of redundant capacity. Preserve freedom. That optionality comes from both savings and from maintaining skills that are marketable in midlife. We've built the foundation. We've made the math feel immediate and the psychology visible. The next segment will examine the remaining two principles in more detail, and then we'll walk through a side-by-side 15-year trajectory of the disciplined midlifer versus the improviser, with clear numerical sketches that reveal how small differences in behavior compound into vastly different outcomes. We'll also turn the 5 principles into a one-page implementation checklist you can use this week. One final necessary reminder before we pause. Nothing here guarantees outcomes. The purpose is to change the odds in your favor by insisting on humility, process, and the things you control. This is educational content and not personal financial advice. If you need a tailored plan, speak with a qualified professional. If the approach I've outlined so far resonates, subscribe for the full series where we break down each principle, illustrate the math, and give you an actionable checklist to apply within 30 days. In the next segment, we'll step into the numerical case study and show what happens when a midlife plan meets real-world shocks, and what choices preserve freedom versus what choices narrow it. We now step into the numerical case study and follow 2 plausible 15-year trajectories, so you can see how small, disciplined differences compound into very different levels of freedom. Remember, these numbers are illustrative hypotheticals, not promises or advice. They assume simple, round returns and steady contributions to make the point about behavior and structure, not to forecast exact outcomes. Start with the discipline path. Mark is 42. He has $400,000 saved across retirement accounts and taxable investments. He contributes $12,000 a year to his savings and expects, for the sake of this illustration, a long-run average return of 6% per year before inflation. He builds a margin of safety, 3 years of essential spending in liquid reserves, a conservative allocation for money he will likely need within 5 years, and 3 micro rules he follows without exception. No single position above 10% of net worth. Any new investment must pass the 3-question test, and he automates savings increases each year by 1 percentage point of his salary. On the other side is the improviser. Dana is 53. She has $600,000 saved. Feeling behind because her peers appear to be further along, she shifts aggressively into a few high-volatility ideas after a period of market euphoria. She does not maintain a sizable liquid reserve because she views cash as dead money. When volatility turns extreme, she is forced to make decisions under pressure. Now imagine both face the same major market shock in year 3, a drawn-out bear market that wipes out 40% of equity values. The mechanics here matter. Mark's margin of safety, steady contributions, and diversified holdings reduce the impact. Dana's concentration magnifies it. Let's walk the math slowly and plainly. If Mark begins with $400,000 and contributes $12,000 a year at a steady 6% return, he will accumulate roughly $160,000 over 15 years if markets behave smoothly. That's the arithmetic of contributions plus compounding. But markets are not smooth. When the 40% drawdown hits in year 3, Mark's portfolio drops, but his liquid reserves and lower concentration mean he does not need to sell. He cuts discretionary spending for a year, maintains contributions, and benefits from the lower base when markets eventually recover. Because he never sold at a low point, His recovery requires only that the portfolio appreciate back to previous levels. A painful period, but one he was built to withstand. Contrast that with Dana. Suppose she allocated 35% of her $600,000 into concentrated speculative positions that subsequently dropped by 70% during the same shock. The concentrated slice evaporates from $210,000 to $63,000, a loss of $147,000. Her total falls from $600,000 to $453,000, a 24.5% decline. Without an emergency fund and facing higher near-term spending needs, Dana is forced to liquidate assets at depressed prices to cover living costs or withdrawals. Those forced sales lock in losses and reduce the capital base that could have compounded on the recovery. Even if markets climb 30% in the following years, the mathematics of recovery are blunt. You need larger percentage gains to return to prior peaks after steep losses, and forced selling can sever your ability to capture those gains. Beyond the pure percentages, there's the sequence of returns problem. If Dana needs to withdraw from her portfolio in the immediate years following the downturn, those withdrawals come from a diminished asset base. She sells the cheapest shares and depletes positions that otherwise would have grown back. Mark, by contrast, whose withdrawals are delayed or covered by liquid reserves, allows the recovery to compound uninterrupted. The same average long-term return can produce drastically different practical outcomes because of timing and behavioral choices. We can make this more concrete with a simplified table in prose. Imagine both start their 15-year window at the given amounts. They both experience year-by-year returns that average 6% over the period, but the order differs. A deep early loss for both, followed by recovery, and then steady returns. Mark keeps contributing. Dana cuts contributions and sells into losses. At year 15, Mark's account is materially larger, and he retains optionality. The ability to reduce work hours, to support family, to take a planned semi-retirement. Dana's account is smaller, and she faces a narrower set of choices. Perhaps later costly job decisions or reduced lifestyle flexibility. It's not that Mark was luckier in returns. He was luckier in the way he responded and in the buffers he built before the shock. A crucial lesson here is that the single most powerful lever for a midlife investor is not predicting the next hot sector. It's the combination of steady savings and rules that prevent panic behavior. Increasing your savings rate is not glamorous, but it is reliable. If Mark had instead hoped to catch up via risky bets that blew up, his nominal savings advantage would have been irrelevant. If Dana had augmented her savings rate earlier instead of chasing speculative returns, she likely would have had a similar nest egg with less stress. Now, let's return to the 5 principles and examine 2 of them in more detail, because midlife implementation struggles often live in their tension, the interplay between invest within your circle of competence and consistency over intensity, and between increase savings rate and reduce risk as horizon shortens. These are not independent. They must be practiced together. Invest within your circle of competence is straightforward in concept, but hard in execution. The practical test you can use today is concrete. Can you, in one paragraph, explain the economic reason your investment should work? List 2 distinct risks to that thesis and identify a plausible, observable signal that would make you reconsider the position? If you cannot meet that test, You should treat the holding as outside your circle and either reduce exposure or create a strict stop-loss or review mechanism. The reason this matters after 40 is that there is less time to recover from a conviction gone wrong, and compounding is less forgiving of big errors. A single position that you cannot defend intellectually becomes a behavioral trap when headlines and friends push narratives. Consistency over intensity is the behavioral counterweight. It's the acknowledgement that humans are terrible at timing. The remedy is to make the decision environment deterministic instead of emotional. Automate savings, set rules for rebalancing, schedule a quarterly review that coincides with paying bills, and keep a no-go list of activities you will avoid when noise is high. These rituals reduce the need to exercise willpower in the heat of the moment. If you link the two principles, you end up with a practical rule. Stay inside your competence by default. And if you ever step outside it, make that step intentional, small, and reversible. Never make large, concentrated departures in the name of catching up. Next, consider the tension between increasing savings rate and reducing risk as the horizon shortens. Many people believe they can have both higher savings and higher risk simultaneously. In reality, higher risk increases the probability of drawdowns that will force earlier withdrawals or behavior changes that undercut savings. The solution is to sequence. First, raise savings to build the numeric buffer. Then, adjust risk gradually so the portfolio's volatility aligns with the intended time to spend. That sequencing preserves both upside and the capacity to remain invested through rough patches. With these deeper explanations in mind, let's move to exact, executable micro-actions you can implement within the next 7 days. These are deliberately small so you can build momentum. First, calculate your real spending horizon. Not a vague someday, but a concrete year when you expect to start drawing on savings for at least a portion of living expenses. Write it down. Next, compute your essential annual spending for that horizon. What you absolutely cannot cut without serious lifestyle harm. Third, set or verify your liquid reserve target using that essential spending number. If you have job uncertainty, aim toward 2 to 5 years of essentials in cash or near cash. If your job is stable and you enjoy broad income sources, a smaller buffer may suffice. The point is to match liquidity with realistic needs. Fourth, increase your automatic savings by a meaningful, credible amount. If you can't raise it by 5 percentage points right away, pick a concrete dollar figure you can sustain, $200 or $500 per month, and automate it. Fifth, perform the one holding test. Pick the most opaque position in your portfolio and force yourself to answer the 3 questions in one paragraph. If you can't, decide on a reduction threshold now. Sixth, set a maximum position size rule for the future. A percentage of net worth you will not exceed for any single holding. Seventh, create a rebalancing calendar and a 3-step checklist you will run when markets spike or crash. These micro-actions encode the 5 principles into behavior. They reduce regret by removing the heroic last-minute decisions that ruin plans. They also nudge psychology toward the Munger-style humility the title asks you to unlock. Cautious, curious, and disciplined. We also need to tackle 2 practical, but often neglected, structural considerations: the order of withdrawals during retirement and the alignment of account types with spending needs. This is not tax advice. It is an illustration of structural planning that affects how far your money will go. Think of account buckets as tools with different friction levels and tax treatments. When you plan withdrawals, the sequence in which you draw from accounts matters because taxes, penalties, and the timing of required minimum distributions can influence how long assets last. That complexity is why a simple checklist and a conversation with a licensed professional are complementary. You do the behavioral work and cover the obvious structural moves. Your advisor helps optimize within legal and tax frameworks. Even without professional help, you can improve your odds by understanding that account structure is a controllable factor and by aligning near-term cash needs with more liquid or lower volatility buckets. Let's return now to a richer, year-by-year sketch of the two 15-year trajectories, so the contrast is unmistakable. Keep the assumptions explicit, steady contributions for those who can make them, an early severe drawdown in year 3, and different behavioral responses. For Mark, we assume continued savings, modest temporary cuts in discretionary spending in the downturn, preserved positions, and an eventual recovery that allows compounding to resume. For Dana, we assume concentration, forced selling, reduced contributions after the shock, and slower recovery of net worth due to realized losses and missed compounding. At the margin, the difference in final outcomes is not determined purely by returns. It's determined by 3 behavioral choices: whether you sell into loss, whether you halt contributions when markets fall, and whether you preserve liquidity to cover near-term needs. If you prevent all 3 errors, you dramatically increase the odds that an adverse sequence of returns will be a painful episode rather than a life-altering catastrophe. Now, before you imagine this is only about big portfolio decisions, consider how everyday lifestyle choices feed the engine. 2 people with the same salary and saving rate can end up on different trajectories depending on spending choices, debt management, and family obligations. Small actions compound. Cutting recurring subscriptions, negotiating insurance or service prices, or redirecting a yearly bonus into savings rather than immediate consumption. Those changes add up. Munger-style discipline values marginal improvements. He favored compounding small advantages over time and treated avoidance of catastrophic errors as more important than chasing occasional brilliant wins. At this point, you might be asking for a 1-page implementation checklist you can use this week. Below is a compact, actionable checklist written in plain language so you can follow it now. Treat each line as a firm step, not a suggestion. First, write down the year you plan to begin meaningful withdrawals and the amount of essential annual spending you will need at that time. Second, calculate liquid reserves measured in months or years of essentials. Then transfer or earmark funds to meet that target. Third, increase automatic savings by a fixed dollar amount or a % of income and set it to run on autopilot. Fourth, run the 1-paragraph test for each holding you feel fuzzy about. Reduce exposure if you cannot justify the position succinctly. Fifth, set a single position cap and a rule for rebalancing. For instance, rebalance quarterly if any asset class drifts more than a predefined percentage. Sixth, Write 3 micro rules for crisis behavior, a forced pause before selling, a review checklist for large moves, and a consultation step for decisions that would materially change your allocation. 7th, create a quarterly ritual. Calendar a specific date for a short portfolio review and a separate date for lifestyle and spending check-ins. 8th, list the skills or gig opportunities you could cultivate in the next 2 years to increase optionality if needed. 9th, write down 1 social action, unsubscribe from 2 sources that push speculative noise, and identify 1 trusted voice you will listen to for measured guidance. Each item is intentionally small because large, imperfect action beats perfect inaction. The checklist turns abstract principle into work that fits in your calendar and your psychology. It also creates visible, repeatable behavior you can inspect and adjust. Let's address a common midlife misconception directly. Many people believe that protecting capital means sacrificing all growth. That is false. Protection in this framework means managing the odds so that you can remain invested through adverse stretches and let compounding work over time. It does not require withdrawing entirely from growth assets. Instead, it asks you to be thoughtful about allocation, to keep liquidity sufficient for near-term needs, and to reduce unnecessary concentration. Historically, investors who tried to avoid all risk often experienced hidden losses through inflation, missed growth, or declining standard of living. The Munger-style prescription balances protection and growth by prioritizing downside control first and then allowing sensible exposure to growth where it makes sense within the horizon and competence constraints. Another uncomfortable but essential point: discipline is social friction. Saying no to a friend's hot tip or declining to follow a trending strategy is awkward. Discipline will sometimes mean you are the lone voice in a noisy room. That's an acceptable cost when the alternative is the erosion of optionality. Honor the small social frictions as a price for future freedom. Before we close the case study, consider a reserve mental model that helps midlife investors choose rationally. Treat catastrophic loss as the only truly irreversible outcome that matters. Lost time, lost ability to work, or health shocks have compounding effects. Preserving the ability to respond to non-financial shocks, keeping energy, health, relationships, and adaptable skills is part of the margin of safety. Money is a tool to preserve options. A Munger-style approach refuses to gamble those options away for glamour or social signaling. We're now ready to translate everything into a 30-day starter plan that imposes a reasonable workload without being overwhelming. Week 1. Complete the written inventory we discussed earlier. Horizon, essential spending, liquid reserves, and a 1-sentence rationale for every holding. Week 2. Automate an immediate increase in savings and set up the micro rule transfers, the daily or monthly auto pay that funds those increases. Week 3. Apply the 1-paragraph test to the 3 most uncertain holdings and decide on an action. Reduce, hold, or set a review trigger. Week 4. Install 2 rituals: a quarterly portfolio check scheduled on a fixed date and a no-go list to avoid speculative temptations. Each week's tasks are short but decisive. Their cumulative effect is powerful. We must also acknowledge practical obstacles you will face. Your partner may disagree about the level of risk or the pace of savings increases. Your company may pay bonuses that are tempting to spend, or you may feel pressure to match friends' lifestyles. The remedy here is communication and pre-commitment. Share the written plan with a partner. Create joint rules about shared liquidity and commit to an annual review where you both agree on exceptions and adjustments. If social pressure is intense, create distance from sources of noise. Social media feeds, newsletters that trade on emotion, and late-night market talk. As you implement, measure progress in process, not in daily account values. Success is establishing rules and following them reliably for months, not chasing immediate gains. Celebrate small wins, a sustained savings increase, the sale of a position you didn't understand, or a full emergency fund transferred into place. Those wins are more powerful for long-term outcomes than a single lucky trade. We must close with an honest, decisive framing. After 40, your primary job is to protect your future freedom by shaping the odds you face. That means prioritizing margin of safety, increasing what you can control, savings, understanding, and allocation discipline, and shrinking exposure to fragility. The choice is stark only because people tend to treat it as an optional, romantic idea, rather than the practical, disciplined work it is. You can remain dazzled by shortcuts, or you can adopt a boring, powerful set of behaviors that materially increase the probability of a calm, self-directed future. This is educational content, not personal financial advice. If you need tailored recommendations, consult a licensed financial professional who can account for your taxes, legal circumstances, and unique situation. If you're ready to act, here is the single decisive next step. Pick one item from the 30-day starter plan and complete it this week. Make the action visible. Write down the completed task. Set the automation in place and schedule the quarterly review on your calendar. Tiny visible steps create the momentum you can sustain for years. If this message landed with you, subscribe for the full series where we will unpack each principle in detail, run live numerical examples, and provide downloadable templates to implement this approach. Tell us in the comments, what's your single biggest financial fear or your top goal for the next 5 years? Share it honestly. We'll address common themes in upcoming episodes. One final reminder, none of this guarantees outcomes. The purpose is to change the odds in your favor through discipline, humility, and process. The math of loss and recovery doesn't negotiate, but your behavior does. Choose a path that preserves options rather than one that depends on luck. Your future freedom deserves the boring work of protection before growth.